What's up, everybody? We're back with another edition of the Scaries Stock Talk podcast, and I'm here with special guest at Deer Point Mac. If you're following me on Twitter at Green Candy, you've known him from our two spaces where we get into stock and macro, and yeah, he's always generous with his time and they usually join in. Deer Point, how you doing?
I'm doing well, Brandon. How are you doing?
I'm doing great. I'm doing great. All right. Well, let's get into it. So, a little bit about you, about your background. I see on your Twitter that you're from North Carolina, and you got a lot of charts that you're great charts that you put out, mostly in purple and orange. So I'm assuming a Clemson fan. But yeah, let's to your background and just a little bit about yourself.
Yeah, so I work within the banking industry. I worked for some banks up in Canada also. It's mostly on the capital markets side. And so the now kind of the area in which I'm focusing is kind of more on the macroeconomic side, really diving into the plumbing of monetary policy and the effect that that has on, let's say, overall markets, whether they be traditional markets or even like some of the decentralized markets. And that's the way that I have been focusing a lot of my research on lately.
Yeah, you put out some great I mentioned earlier, and yeah, I guess one of my questions was going to be see a lot. You put a lot of graphs, mostly comparing the United States and Canada. I think that's because you've worked in both the countries.
Yeah, so it's a little bit of both. What I've noticed that's very interesting about Canada is when I was in Canada, people always kind of try to make this direct comparison to the United States, and so obviously that's very difficult to do. You know, with the U.S., let's say being roughly 20 times the size of Canada in terms of like actual GDP, but it's just kind of looking at the difference between the two economies because those economies are, let's say, so interlinked. Um, and so that's kind of the reason that I've been focusing on Canada and obviously the real estate market and everything going on up there. There's kind of a lot to unpack there. So that's kind of where I've been comparing the two nations broadly because, for example, if you point out the debt situation in Canada, people will be like, well, look at the United States. But, it's not really an apples to apples comparison.
Yeah, for sure. It seems like Canada kind of compares themselves to us, but United States, but not really the other way around. But I guess that's just kind of the reality of the situation here. Um, um, but yeah, there's some big news that's come out recently as far as I guess the U.S. economy has gone. So last week the Fed reported CPI numbers of the month of February for Euro. They reported it as 7.9. I believe that's like a 40-year high point. So a couple questions I have about this. So what do you think about just number representing inflation in the United States? So they kind of just report one, but they give you full breakdown on various items. And then what do you think of like the that number and how much do you kind of take into account when you're looking at all macro environment?
Yeah, so for me, looking at the inflation numbers is sometimes a little bit difficult just because there's so many like exogenous variables that are going on right now. And what I mean by that is, I mean, you have a lot of supply chain issues. There's a lot of things that are, let's say, maybe adding more or less to an inflated CPI number. I do know the US, the inflation number is at a 40-year high. Um, and if you look at like the contributions to headline inflation on a year over year basis, a lot of that's coming actually from the energy side. And then you have food and you have, some goods, excluding food and energy within that. And so kind of what you're saying is when you're actually looking at a lot of those big contributors to the inflation number. It's coming on the back of things that are either imported or things that had many years of underinvestment, in this case, oil, and energy sector, where there's been massive underinvestment, whether you're looking at the OPEC side or actually domestically, that have kind of added to increased inflation. One other thing that I was looking at is kind of the rate of growth, in terms of inflation, and broadly, I mean, the rate of growth is slowing more or less. But obviously, yeah, I know people are kind of worried about that's 7.9 percent number, but I think in the grand scheme of things, um, it's things that are more outside of the Fed's control. So what I mean by that is I wouldn't say that this is much, quote unquote, because of the money printer go burr kind of thing. I think that it's other exogenous factors that are contributing to that high inflation number.
So, what kind of, I guess, exogenous fact talking about? Are you talking mostly about, like, going on between Russia and Ukraine? I know that that was something that the I think President or White House Secretary Jen Psaki came out and said, and that Pelosi also came out and said in an interview that a big portion of it is the war between Ukraine and Russia. Although the CPI numbers that came out last month were for the month of February, and or didn't necessarily start at that time. So I mean, I kind of understand the dependence on, like, oil, that the United States has on the on with Ukraine and Russia. But like, what other, I guess, factors are there you talking about that you think are kind of contributing to this massive inflation that we're seeing?
Yeah, so kind of what I was meaning when we're talking about exogenous factors is, obviously, if you go back to the beginning of 2020, when this whole COVID thing shut down, or when COVID caused all these shutdowns globally, domestically. Um, the way that our supply chain logistics are set up is, it's called just-in-time manufacturing, and basically what that means is, companies keep very limited amounts of inventory, like, actually at hand, and once orders come through, they get the things that they need to put that order together. So hence the reason just in time, so they're not sitting on massive amounts of inventory. So when you shut down the entire global economy, you have this issue, where now complete supply chains are shut down, in a lot of places, whether you're in Canada, for example, or Europe, or the United States. The government came out, and they did transfer payments, so people got the $2,000. So obviously now consumers feel wealthier because they're getting these kind of these STEMI checks from the government. So obviously people want to consume more. People were paying down debt, but there wasn't supply chains open to allow for people to really be able to have that kind of consumption. And so what you get, basically, is you get a leftward shift in supply, which basically pushes the price level up. Um, uh, and you have this rightward shift in demand, which is people wanting to consume more. And so the whole equilibrium model gets thrown out of whack, because there's a big increase in the people's want of consumption, and there's a massive decrease and on the supply side for those suppliers to really be able to go about supplying the materials that are needed. And then now, after you get through all of that, you still had a massive I would say supply chain crunch that they're still trying to work through, where now commodities have gone up, and they're really trying to, I think, create some sort of demand destruction, in the sense that suppliers might not want to take on those increased variable costs, so they might look for substitutes if they can, or if not, it would just try to maybe scare off the demand side, where consumers are going to say, what, X thing that I want to buy is now way above the price level that I think I'm comfortable paying for it. And that's where you kind of hopefully get that demand destruction. But that's where I think most of this inflation is coming from.
Yeah, I took that as well. I think the money printing definitely had to do with it, so I disagree with you there slightly. But of course, you know your experience. You've been doing this for quite a long time compared to me. Just kind of looking into a side thing is something that I enjoy. Um, and so I guess along those lines, we've been in this COVID kind of weird situation for 2 years now. I think that there's going to be, I guess, I know this is kind of a tough prediction, but is there signs that you can tell supply chain is kind of, getting a little bit better, and maybe things in specific industries, for example, the semiconductors or chips or something like that. Um, it seems like in the car market and like that, some of these vehicle manufacturers are to try to produce their own chips to decrease the reliance on third parties. Do you see that as kind of I guess a common trend going forward? Or do you still think, I guess, this supply chain issue kind of a lingering COVID effect for quite a time?
Well, now I think it was going to get better. I mean, I was pretty optimistic. And there's some charts that I threw up that are actually, brought about by the New York Fed, and that's the Global Supply Chain Pressure Index. It was starting to fall, and I think the last reading came out was February. But now, fast forward to where we are today. Korea, I think, had like a spike up to 6,000 cases. China's starting to see, if believe those numbers, is only still 5,000 cases. Um, and so now with China's COVID policy, are they going to actually go through with the zero policy again and shut down supply chains in Shanghai and Hong Kong? And if they do that, then yeah, I think that again, the inflationary pressures are going to get worse, because now one of the largest manufacturers and exporters in the world is now shutting down again. And so what do you do? And I think that that's where, if China actually goes through with those policies and starts shutting down, even I think they said it was up until the end of March. If it's only that short, I mean, still in a matter of weeks, I mean, you're talking hundreds of billions of dollars that need to be exported, because there's demand for those goods, and if those goods aren't being produced, I think that yeah, the inflation, at least on the supply side, could get much worse.
Yeah, so I think I actually saw today that China is shutting down, or at least, highly considering it. So yeah, it definitely seems like a worry. But because of the effects of the last pandemic, and the lingering effects we're seeing now to the United States economy, and globally to the economy. um it I find it very difficult to think that that we're going to shut down. um but then again, I'm no medical expert or anything like that, and I know that's not your forte. But do you think that the global economy could basically, could we even survive shutting down like that again? Or, would something along those lines be pretty catastrophic for I guess the economy? Not to get all doom and gloom. Yeah, what are your thoughts on that?
Well, I think the problem here is you get into the debate of, is this a harm due to globalization? Because obviously, then you get into kind of the, should we have globalized, or should we have stuck to like a protectionist path, where the things that we could make were broadly, like, I mean, the US would have the ability to manufacture many things stateside. That's not as much of a, a problem for us. I mean, we have oil and gas, et cetera. And so then the issue is, do you start to see countries maybe shifting away from mass globalization and trying to utilize more resources at home, so that you don't have these kind of issues if another pandemic breaks out. And so maybe we might see a shift more to protectionism, in terms of making sure that we are not broadly relying as much on outside manufacturing. So if these things happen, the consumer doesn't get hit as hard. But on the backside of that, obviously there's going to be a lot of additional cost increases. And so therefore, that's where you kind of get into, what do you do? Because the consumer obviously wants cheaper goods if things have to be manufactured stateside. because of different regulatory regimes, minimum wage, etc. Obviously, that could be other input costs that are going to raise the price of consumer goods, and I think that that's um, kind of a difficult question to answer.
Yeah, I mean, definitely a tough one. Well, let's shift gears a bit. So the Fed announced that at the time of this recording, we're on the 16th. They announced their rates 25 basis points to 0.25% from zero. So I guess just on a little bit for our audience, like what does raising mean? Like what are the lingering of, and how do you feel this Fed's decision to raise to 5 basis points?
Yeah, I think in the short term, it does have effects. I mean, I think that that's why you're seeing the short end of the curve, um, talking about the yield curve rise so rapidly. Um, but broadly, I don't see this really meaning much in the global sense or like really being more than a nothing burger, right? Because if you look at swap curves, they're still completely compressed. So you're not really seeing a paradigm where this 25 basis points is really going to mean much in the grand scheme of things. Liquidity, I would say, is already relatively tight if you look at some of the consumer metric, or like some of the growth numbers in terms of like commercial and industrial loans. Um, but I think it's nothing really more than just like a maybe I don't want to say like virtue signaling, but it's basically a nothing burger, because I don't think the economy is really at the point where we can start raising rates. And I think you start to see that the more you look out the medium and long term end of the curve. Um, and so, yeah, I mean, you're going to have some short term effects in terms of liquidity effects, but medium and long term, it's the Fed's it's beyond their control.
Yeah, so they also said today that they're kind of penciling in and there's remaining six more readings to keep increasing rates to about 1.9 by year's end. And then they also 3 more rate hikes going on in three. So from your experience, when the Fed kind of says or hints something like this, does the market kind of play into this, and does the market, I guess, what's a good way to put it? Does the market kind of take into account the rate hike early? And do you even foresee like the Fed following through with all these?
Um, yeah, so I think the market is broadly optimistic. I think the Fed's broadly, and I think if you actually listen to Jay Powell and they're like, "Oh, are we actually going to get 7 rate hikes?" He's like, like he kind of didn't want to be like, "Yeah, we're doing 7 rate hikes," because I think Powell knows that we can't get 7 rate hikes. Um, so kind of what I think, again, I don't think the conditions are there. I think you get maybe let's just slice it down the middle and say 2. I say it's going to be between 1 and 3, so I'll just take the median and just say it's 2 here, and I think that that's going to be it, just because, and Lacey Hunt has pointed this out. If you get 3, there's a high, like, the yield curve would probably most definitely invert on the twos tens, and then you run into like actually you're going to have a recession. And not just that, but as Lacey Hunt also pointed out, you have the whole issue of bank profitability, and banks would just be getting killed there. So I don't think you go 7. Again, I think, and Jeff Snyder does a lot of work on that also. So if you look at where, again, the swap curves are, which is basically just like, you take a vanilla like interest rate swap against a similar uh, 10-year US Treasury. Those have been extremely negative basically since 2008, like persistently negative, right? There's some times where they peak up over, but the market should be theoretically, if this is where we're going, it should no longer be negative. It should start moving upward, but you haven't seen that. You're still seeing this compression on the swap curve market. And then if you go to the euro dollar, the futures curve, I think as of January, it was also inverted. So even on the euro dollar, which is basically has nothing to do with the euro, just for people who aren't sure, it's just dollars that are operating outside of like the US. So it's things that the Federal Reserve can't really get its hands on. It's, outside of our control. And that curve is already inverted. Like I said, I think up through January. And so that's again disagreeing with the 7 rate hikes. It's maybe pricing in 1 to 2. And like I said, you go back to the medium and long end of the curve and how flat it is. Yeah, I think the market again is just it's saying, you can, the short end's rising, but the medium and long end is so flat because I don't think we see it going there.
Yeah, I mean, after the announcement, it seemed like everything kind of was floating around just about even, and then it kind of shot up a little bit towards the end of the day. Um, but yeah, you've kind of alluded to a recession session, and it almost seems like it's inevitable at this point, at least from my perspective. Um, I guess talk about your thoughts. We talked about it a little bit on our Twitters. Talk about your thoughts on, I guess, the impending recession. Do you think that there's going to be one? Do you think it's going to be long, big and nasty? How do you think? How do you think that this whole situation kind of plays out?
Yeah, I don't think it's going to be long or nasty. I think maybe you have if again, if we don't get an inversion of the yield curve, or the Fed doesn't actually end up doing like 5 rate hikes, but if we're just getting one or 2 or 3 rate hikes, you might have 1 quarter of negative GDP growth. But I think after that, it'll just go back to kind of the 2% range, I believe, where GDP has been averaging over, I would say, probably the last decade. Might be a little bit lower than that. I don't have the number in front of me, but let's just call it 2%. I think that's where you'll go back to. So I think maybe it's 1 quarter. But yeah, I mean, if you get and the reason that I say 1 quarter, because 1 quarter is not necessarily the definition of a recession, right? So, but like where you're talking like what the NBR considers a recession, like 2 quarters of negative GDP growth, I think you would really only see that if the Fed did do more than 3 and just continued on path. Then yeah, I think growth would absolutely would get obliterated.
Okay, so yeah, maybe a quarter or so, or a quote unquote recession. So you kind of see it as more short term. I'm not sure. I'm not sure. I get I the way I view it, and I'm obviously not in this field or anything like that. It seems to me that things just keep getting worse, and that the Fed's solution or the Fed doesn't really know how to combat it, and that all this inflation is kind of widening the wealth, and it seems like to me a lot of these are paying industries and small businesses are suffering the lingering effect for from the COVID pandemic. So what kind of industries do you I'm not sure if this might be your specialty, but it's kind of my just initial thought here is like what industries are gonna be kind of hit the hardest, and do you think like during this recession some of them will still kind of skyrocket? Do you think I guess the housing bubble will kind of pop, or do you think everything along those lines will still keep going up? That and I guess specifically the auto are the two that really come to mind.
Yeah, so for the housing, I think housing's already started to cool. It has peaked. Like if you look at the MBA, which is the Mortgage Bankers Association. Sorry, they have a mortgage purchaser index, and I did have that stat. Just give me 1 second. I'm trying to get that up. I do know that this has changed. This was last week, so I need to revise this. But I know that the index fell. around like almost 2%. And that came in at, I think, 246. I think the one that came out this week was at like 262. So the purchaser index has started to rise slightly, but on the back of, rising mortgage rates, which at that time were, I think, like 4.2%. You had already started to see a real, let's say, deflating in, the mortgage purchasers index. I think refinancing fell about 16%, and mortgage loan application volume fell like, I think, roughly like 13% also. So you were already kind of seeing this easing on the mortgage side. Um, but if you were to get, let's say, a recession, obviously it would hurt the home builders. Obviously, anything that's going to be, it depends on how long they're financing. If you get an inversion, then obviously, borrowing on the long end would actually be better than borrowing on the short end. So, in that circumstance, they would be better off. So like more capex intensive things would be better off if you got an inversion. But I think if we go through with my inversion narrative, financials would get hit the hardest. And there's a reason behind that. Again, I would defer to Lacey Hunt, much smarter than I am, but banks are basically borrowing short and they're lending long. And so if you get that inversion, because they're borrowing short and lending long, they would get absolutely slapped in terms of profitability. And so like industries like that, I think would suffer. Again, if you had that inversion, which is kind of the paradigm that I see, um, you would like anything capex intensive would probably end up being okay. You might have some squeezes in profitability, but overall, I think anything capex intensive would do better when you get inversion, because just obviously with the 2 year being higher than the 10, for example, that makes those long end or medium end points of the curve cheaper in terms of actual like borrowing costs. So yeah, I would stay away probably broadly if I was looking at industries from the financials.
Gotcha. Yeah. Well, let's shift gears a little bit, more towards, I guess, the strength of the U.S. dollar. So I'm very public that I'm a Bitcoin guy, and I believe in that, but I still think that we're kind of a ways away from moving away from the U.S. dollar. But in my opinion, we've kind of seen a few cracks in the armor, fairly recent. Um, but I believe, different opinion. I don't want to put words in your mouth, but some things that have come to mind are some oil deals that China and Russia have been in various currencies outside of the U.S. dollar. I said about this earlier today. But is this something that worries you about the U.S. dollar going forward, or is it kind of a nothing burger as well? And how do you feel about the overall strength of the U.S. dollar as I guess kind of like the global reserve status going forward?
Yeah, I think the US dollar is going to continue its strength. And I think that's just because if you look again around the world, I like to say the US is the cleanest dirty shirt in the basket, right? And so I think that, if you look around the world, obviously the US has the best outlook. And so therefore, I think a lot of other investors see that. So the US is always going to kind of be that flight to safety. And I think that the US dollar will probably continue to catch a bid. I know now there's the Juan Real thing going on broadly. Now I know that the Juan is, under a basket, and instead of just being completely pegged to the dollar, but still, the strength of the dollar is extremely important to China domestically. Um, maybe some exports and things like that. The dollar doesn't play as much of a significant role, but what's very interesting is if you actually look at that basket, I think the renminbi's lost like 10% of its value against that basket. Um, and so, again, um, even Saudi Arabia, which again is broadly pegged to the dollar, I think again that's a big nothing burger because Saudi Arabia produces absolutely nothing besides oil. 80% of their food exports, or 80% of their food imports, sorry, come from the U.S. Um, and so, like, I don't really see the benefit to Saudi Arabia from moving away from that, except maybe in some, manufacturing items. But again, I don't think, um, if Saudi Arabia or China wants to transact, let's say, mostly on the global economic scale, it has to be done in dollars, right? Like even if and this goes kind of to Brent Johnson's point, but if China wants steel from Australia, they have to do that transaction in dollars, right? So like, or if Saudi Arabia wants to buy, coffee from Brazil, even though I mean they have Ethiopia and Yemen there, but just as an example, Saudi Arabia has to buy that coffee from Brazil in dollars. So I think the dollar's dominance is still going to be completely important. And like I said, on the back end of global uncertainty, I think the dollar will again be seen as a safe haven.
So, I guess yeah, I hear you with that point. Like, take a lot to kind of move away from the dollar. At least with things are the way things are set up right now. But a lot of these countries, obviously not the big players that you mentioned. Like China, Russia, maybe smaller ones. Like else comes to mind, and Ukraine and Mexico recently made Bitcoin legal tender in a small city in Switzerland. As somebody is like kind of an outsider from the Bitcoin space looking in, do you take any significant that, or do you think that a country that's like a major exporter, X, Y, or Z is going to need to make it where that they'll only do deals in certain, in Bitcoin, for example, or do you still think that the exchange mediums is a long time in order to move away from the US dollar if that ever happens?
Yeah, I think it. I mean, like, what is a long time, right? But like the next 10 or 15 years, I think, let's just say broadly, it would still be the U.S. dollar, just because even if you wanted to shift to something else, even without the Bitcoin narrative, I mean, what currency do you use, right? The euro, probably not. The renminbi, well, no. And so like those are kind of like, I mean, broadly the currencies that would probably have the highest likelihood of being chosen, even the yen. But obviously, I mean, Japan's far worse than the U.S. is. Um, and so even if you start to get to the Bitcoin narrative, the thing is like, if you wanted to adopt Bitcoin as like a global monetary system, you would have to find a way to like smooth out the volatility, because as things are now, if I ship you if I ship you some good, like a commodity, and en route, up until a certain point in that journey, I'm responsible for any price fluctuations in the price of that commodity, right? And so, for example, if the Bitcoin lost value, and then there was some effect on the price level of that commodity, or if Bitcoin went up in value, or just because of the implied volatility and the repricing of that good, even if we're just talking about not even in fiat terms, just in Bitcoin terms, I think that would just cause so much instability in the ability to be able to continue global transactions, just because me as the shipper, again, like I was saying, I'm in charge for that, the price fluctuations, and that's why a lot of these commodity companies have like commodity desks that try to hedge that on the back end. So again, like, I'm responsible for all that, and I three aces touched on that in that pod, and so this is where it gets very difficult, at least in the current term, until there's a way to get the volatility down to like a normal fiat currency, which I think is like 3 to 5%, right? So until you see that, I think that the Bitcoin and the monetary takeover it's kind of a difficult path to see as we are today.
Yeah, I gotcha. I mean, and it makes sense. I think what gets lost in Bitcoin realm is everybody kind of sees the issues, and I think it as well. The issues in the current monetary system that we're in. Obviously it's not perfect. Needs to be another out there, and I think everybody in the Bitcoin realm, realizes, how useful of a tool, how powerful the technology is, um, and excited about all the news and things like that. But one thing I'm always trying to do is talk to intelligent people like who are in the, I guess, broader macro space too, to kind of stand a lot of the hurdles, that would need to be overcome in order for that change to be made. Um, and all points here make sense too. So I definitely think that there's path to it, but I think that we're seeing a lot of jump, and I think a lot of the monetary policy, that kind of happened recently with COVID and the massive money printing. People are kind of pushing it a little quicker, or a little now. There's a lot more people interested in the space, but I still think that there's still a decent ways away. Whether it's just 10 to 15 years or what. I'm not sure how much this might have accelerated it, whether it was like, pre 30 years away and now it's 2020. That's something that's kind of hard to predict, but I think, for one, there's going to be, there's a lot of hurdles through, and the people in power now are, going to be resistant to giving up that power. So yeah, if you got kind of anything else to add to that rant, feel free.
Yeah, I mean, I realize like some people might be uncomfortable with the way that the monetary system works. But again, I just think that there's a lot of, let's say, right now, headwinds for the replace, or like for Bitcoin to come in and take over. And what's very interesting, and again, Three Aces even touched on that, and he's a Bitcoin guy. But if you overlay, and obviously correlation doesn't necessarily equal causation, right? But if you overlay the like Bitcoin over ARC or some other high beta assets, you find that it actually follows those high beta assets extremely closely. And like I said, correlation doesn't necessarily equal causation. But it seems that for me, when I'm looking, broadly speaking, at the use of Bitcoin, it seems like it's being used as more of a risk on asset as opposed to like risk off. And I think that that is what is very interesting about it, because obviously if something's going to be a store of value, you're going to want it to be risk off, like gold. I mean, gold doesn't catch a bid if there's no inflation, or if there's no like economic uncertainty, right? And what was kind of interesting was when Russia Ukraine happened. I think Bitcoin fell, if I'm not mistaken, at least for like the first couple of hours that was happening. But the futures market on gold rallied, right? So like this is where it gets kind of complex, where you see, okay, like people are now using, and yeah, I know people used Bitcoin and stuff to get out the Ukraine, but like what I'm saying was the market was saying, okay, uh, geopolitical uncertainty, rush to gold, Bitcoin sell off, and that's where I just see like this is where I guess it's a complicated topic, right? And again, Bitcoin's such a new, relatively new asset class, or just cryptocurrencies in general. I think that there's a lot more study that has to go into it.
Yeah, definitely. I think there's a lot more that kind of goes into it as well. I think we're still very early in this space. Bitcoin started in 2008, right after, and so it's what, 14 years now almost. I believe towards the end of, or the white paper was published in the end of 2000. So, yeah, I still think that there's a long ways to go, but I'm very bullish on the space going forward. Um, but yeah, so we'll kind of go a little bit more specific. We've been kind of talking a little bit more globally. I see you do a lot of comparison. We kind of stated earlier between Canada and the United States. So there's a couple of these charts that I see you tweeted recently, and I just kind of want to talk about them and see your overall thought. So the first one is more so on the investments and intellectual property between you tweeted out March 11th, and you just kind of said the tale of two economies. One values investments, and the other and real assets like equipment, machinery, and the other is isn't as important, and residential RE is the way to go, and the ratio speaks volumes. So from this chart, it looks like the United States is kind of falling over the past, what is this, 2016, where Canada is kind of steadily rising since time. How do you view, I guess, this chart, and you want to break it down for us a bit?
Yeah, so this is the ratio between residential investment and investment in machinery, equipments, and intellectual property, right? So what this is showing is that um, the U.S. is falling, but that means that the U.S. is investing less in residential like investments. So that would be, like 1 in 4 like homes structures like that, and we're investing more in machinery and equipment, intellectual property. Now, on the Canada side, what it's showing is that Canada is not investing in machineries, equipment, and intellectual property, but instead Canada is investing in residential like investments, so real estate, basically. And that is a big issue because real estate doesn't add anything productive to the economy, right? And that's kind of what this chart is showing.
Okay. So yeah. I guess that kind of leads to the reason why we're seeing kind of a big housing boom in Canada, or at least is it safe to assume that these are kind of correlated? The I where I'm pretty close with some of the Canadian boys up there. I record a lot with the Canadian Bitcoiners podcast, and I have a connection with a lot of those guys up, and they always allude to housing being very unaffordable. And the big metropolitan areas in Canada. Do you think that that's kind of I guess a leading cause for that?
Yeah, I mean, it's definitely a leading cause, and I think once, and without getting too much into politics, but once the current government came in and kind of moved away from this investment in the oil and gas industry, you had to find something else to pick up the slack for that, chunk of GDP coming out of the economy. And so I think the way that they did that was through real estate. And so, instead of investing in things that add to productivity of a nation, they've just decided to just, full send it into real estate. And I think that that is, definitely adding to the problem because, if you can earn, 30%, I mean, like, I think the last 2 years, if I'm not correct, I would have to ask Abe, he would be the guy on that. But I think over the last 2 years, real estate, at least in Toronto and Vancouver, I think has been up between like 19 and 30% year over year. So like, why would you want to invest, like if you're building something, especially like pre-construction condos. Like, I mean, that's really the way to go about it. And condos kind of got hit in the beginning of the pandemic, so they might have not been the best example here. But I think that that's where people are just saying, like, this is where we should allocate capital, because the government's never going to let anything happen to deflate the real estate bubble.
Gotcha. All right. So there's one other that kind of is along those lines. You've kind of alluded to you know to this slightly with the last, but I want to talk about your chart about the um, productivity gap between the United States and Canada. It seems to be growing as well. And I got a couple questions on this. Is how do you get the trick? And how do you I guess how do you view that the labor productivity is going? Do you think that the United States has been pretty successful allowing businesses to grow by limiting taxation, things like that, and giving more money to businesses and letting the kind of like the free market play itself out? Do you still see like the United States being, I guess, really good in that area? And do you still see that as wages are going to start increase? We're seeing minimum wage increase across the United States to $15 an hour. Are kind of jumping jobs left and right. Do you see that this trend of people kind of chasing the next bag still increasing productivity, or do you still see it kind of, I guess, stalling out over time?
Yeah, so kind of the way that I'm looking at this is, when you look at like productivity, basically what it's valuing is how much output of goods and services you can get for every 1 hour of input, basically, right? So what this is showing is, over time, the gap in productivity um, is obviously one of the causes for higher wages between the United States and Canada. We produce roughly $70 of value per hour versus Canada's 50. And that kind of goes back to the investments in machinery and equipment. So the more that you invest in machinery and equipment and technology,
Dear Point, are you there? I think I lost you. Dear Point, you hear me? Dear Point. Right, I lost you for a second. Can you hear me?
yes, sorry, yeah, there's we're having like a rainstorm down here in the southeast, so the internet must have gone out. Am I good now?
You're good now. So we were kind of talking about the your chart between productivity of the United States and the productivity of Canada. How it's kind of the gaps increasing. So if you kind of want to dive into that, you could just kind of start your point there. It's about your chart that you put out the other day.
Yeah, sorry. So what I was saying on that issue was that basically what this is showing is that the more that you invest in machinery and equipment, the more output you can produce per hour of labor, right? And so that makes productivity more efficient. So the more you invest in machinery and equipment technology, the more efficient you have, the more efficient the plant or whatever the manufacturer is, because they're able to produce more output. And so I know that some people will say, well, look at net exports. That was like one of the comments um, on the post. But one, if you look at net exports, especially in the context of COVID, because net exports in the U.S. have been falling. I mean, the dollar has been relatively strong, extremely, especially in like the past, like let's say year and a half. Um, and so obviously that makes U.S. goods more expensive, right? So obviously people are not going to be importing U.S. goods, especially now with the dollar almost at 100, right? The DXY. Um, and so also what Milton Friedman said is, the fewer exports that you have compared to imports, it's actually good, because it means that your exports are worth more than the imports. So like if you're running a trade balance, that's actually negative for the economy. So Milton Friedman had this massive like big saying that like the deficit doesn't matter, it's government spending, right? And so when you're the reserve currency, we have to run a deficit, as the world wants to hold dollar reserves, and the only way to get those dollar reserves is basically for us to import goods, pay dollars for that, and that's kind of how you get this whole euro dollar system. But that's kind of what I was looking at in terms of comparing productivity, because yes, Canada does export more than they import, and I think they just recently started to run a surplus, but again, for a nation that is a reserve currency, we cannot do that, because there is a demand for dollars. And the only way to get dollars out there is either to import them. And once you saw imports fall off at the beginning of COVID, for example, we had to set up swap lines because nations needed dollars. They didn't have enough dollars to meet, whatever liabilities they needed to meet. So we had to set up swap lines where, basically we were lending collateral to these banks in terms of US dollars, and they had to pay us back. They had to give us the dollars back plus interest. So that's kind of why the US can never run a deficit, because I know some people will say, well, if we're not exporting as much as we're importing, then are we really that productive? But that's not the way to actually look at the chart. So, yeah.
Gotcha. I think both of those charts and a lot of them that you put out are great and really. And I know you get a lot of replies and things like that from them. Keep up the good work. And then I will wrap it up with one last question. So are you bullish or bearish on the overall market going forward? I guess for the rest of so we got I guess three quarters.
Yeah, so for me, it's kind of hard. I guess that you could say broadly I'm neutral. I think that there's going to be areas that are definitely not going to be as optimistic as other areas. But I would say I don't want to lean too far into the bullish direction, but I mean, I do think that there are certain opportunities out there. But I mean, broadly, I think from an economic standpoint, I think the economy is going to slow. I don't think we're going to see some massive boom. And so, like in maybe those contexts, I might not be as bullish. So I know it's kind of a beat around the bush. I guess the easiest way to say I'm agnostic to it. It's just kind of it is what it is, right? I don't lean too far in one direction, except on Canada. Canada, I'm pretty bearish.
Yeah, that makes sense. Yeah. All right. Well, let's wrap it up. Thanks for coming out and time with me and talking. Doing this full on recording. If everybody listening, if you're not following already, check him out at Deer Point Macro on. Post a lot of great stuff. And he also, is kind enough to join me pretty much week at this point every Tuesday night at Eastern time. At Green Candle IT, we host stock and macro space. Anything else you got going on that you want to shout out before I sign us off here?
No, no, just basically everything on my Twitter is probably the place to follow. But
Awesome.
yeah, I think that's it. But again, thank you so much for having me. It was great fun, and I always enjoy talking with you guys. So look forward to doing it again. And obviously Tuesdays we always meet up, and the spaces are growing from when we first started. Like you first started those, so that was good. I think yesterday you almost had 100 people in there. So it's been great fun. I've loved chatting with you all. So again, thank you so much for having me on.
Yeah, and yeah, like I said, thanks for joining us. Thanks for joining us Tuesday, and I think yeah, we're gonna keep those. It's been growing rapidly, and I think it's a big part of what you and Bill and some of the other guys bring to the table, and so I learn a lot about every one of those spaces, and yeah, um, so that's it for the podcast here. I'm Brandon, host of the Sunday Scaries Stock Talk podcast. This recording was on Wednesday, but we're going to release everything Monday. So we hope everybody's having a good weekend so far. Been safe and having a St. Patrick's Day. Check me out on Twitter handle IT, or anywhere you get your podcast, and just follow me at Twitter at Green Candle IT, and you'll see everything else that I got going on. All right. Brandon and Nick are out. Thanks so much for stopping by and listening to us. Later.